Let us see the next question. Mr. X started a business of manufacturing of mobile phone with, highlight the portion, his own funds of rupees 1 lakh. Mr. A started business of manufacturing of bearings by borrowing an amount of rupees 1 lakh. So Mr. X may be a rich person like you, having own funds and started business. Mr. A, poor person like me, borrowing funds and starting the business. Borrowing of the funds at the rate of 10%. Both of them earned operating income EBIT of an amount of rupees say 30,000. Income tax rate is 4040%. You are required to calculate, say there are 4 questions which they have provided. I want you to give answer for the first question and second question in the chat box. So I request all of you to write down answer along with me. Calculation of earning after taxes for Mr. X and for Mr. A. So X and A. Earning before interest and taxes. It is an amount of 30,000. It has been given, dear students, that Mr. X started a business of manufacturing of mobile phone with his own funds. So the amount of the interest that he has to pay is 0. EBIT minus interest is EBT. That is 30,000. Income tax rate is 40%. So tax at the rate of 40%. 30,000 into 40%, that comes to rupees 12,000. Earning after taxes is remaining 60%. That comes to 18,000. This is in case of Mr. X. Mr. A, poor person like me, not having funds. This is 30,000. Amount of the borrowing is 1 lakh. The rate of interest is 10%. So amount of the interest is 10,000. EBIT minus interest, EBT 20,000. 40% of 20,000. It is an amount of 8,000. And the earning after taxes would be 12,000. This is the way earning after taxes will be calculated for Mr. X and Mr. A. Second part of the question speaks that amount by which earning after taxes of A is less than earning after taxes of Mr. X. Please put answer of the second question in the chat box. Answer of the question is extremely simple. It is say 6,000 rupees. We can say that the earning after taxes of A is less than EAT of X. 6,000. How this 6,000 is calculated? It is 18,000 minus 12,000. That is the way it comes to 6,000. Now I want somebody of you to write in the chat box that in spite of the fact that both of them are having same EBIT, why earning after taxes of A is less than earning after taxes of X? Please write answer in the chat box. We understand that say Mr. A does not have his own funds. He had to borrow funds and he had to pay interest. That is the reason earning after taxes of A is less than earning after taxes of X. That is what we understand. One more question to all of you. See, A has paid interest of 10,000, yet his earning after taxes is less by 6,000. So why these two figures are not matching, 10 and 6? So basically we understand that, say, definitely Mr. A is making payment of interest of 10,000. So apparently earning after taxes should be less by 10,000. However, importantly, what happens at, say, this 10,000 is an allowable expense from tax point of view. That is the reason you can see that, say, the earning before taxes of A is less than earning before taxes of X. That is the reason the income tax liability of A is less than the income tax liability of X. By how much? By 4,000. Sir, how did you calculate 4,000? It's very simple. 12,000 minus 8,000. That is the reason we can say that, so the earning after taxes of A is less than earning after taxes of X by an amount of 6,000. This is the way, so this 6,000 rupees can be reconciled. I request all of you to write down answer for the question. Answer for the second question. Earning after taxes of Mr. A is less than Mr. X by rupees 6,000. In bracket write down 18,000 minus 12,000. Third question, slightly a new question. I want you to give answer in the chat box. What is the interest tax shelter or what is the interest tax saving? Dear students, we understand the term interest tax saving or interest tax shelter as amount of the tax that you are able to save due to payment of interest. Interest tax shelter or interest tax saving means amount of the tax that you are able to save due to payment of interest, and it will be calculated as difference between 12,000 and 8,000. And if at all, say you want to do direct calculation, then in that case it is 10,000 into 40%. I request all of you to write an answer along with me. Interest tax saving slash interest tax shelter means amount of tax that the company can save due to payment of interest. Full stop. It is calculated as under. It is interest into tax rate. What is the interest amount? It is 10,000 rupees. Tax rate is 40%. That comes to 4,000. Or otherwise, we can have a kind of working in this question 12 minus 8. because X is required to pay tax of 12,000 and A has to pay lower amount of the tax. Why? Because so there is a tax saving due to payment of interest. Please write down answer. Fourth question, again a new question. If anybody can answer in the chat box, it would be great. Calculation of the cost of funds to Mr. A measured in percentage term. Anybody can write answer for the fourth question in the chat box. Let us have understanding how to make calculation of answer. Answer for the fourth question. The question says that so you're required to calculate cost of funds to Mr. A measured in percentage term. Okay. Now I'm giving explanation to you by two methods. Method number one works in this way. See the amount and cost. What amount of the funds is used in the business? 1 lakh. What is the interest amount? Interest amount is 10,000. When you pay 10,000 rupees of the interest, you get tax saving equal to 4,000. So for using 1 lakh rupee in the business, your cost is 6,000. We want to know that what is the cost for every 100 rupees used in the business. Because cost of funds is required to be calculated in percentage term. So we can say something like this: 6,000 divided by 1 lakh into 100 for getting answer in percentage term. 0.06 into 100, that comes to 6%. This is the way you can compute the answer. It is 6%. See, the logic is you use 1 lakh rupee in the business and for that the cost is 6,000. Then for every 100 rupees, what is the cost? It is 6. That is called 6%. Or otherwise, you can compute the answer in this way. KD, that is cost of debt financing, is interest into 1 minus tax rate divided by amount. See, the amount of the interest is 10,000 into 1 minus income tax rate is 40% divided by 1 lakh. So 10,000 into 0.6, that comes to 6,000 divided by 1 lakh. 0.06, that is 6%. Accordingly, the cost of debt financing is calculated. Now, let us have some understanding of this numerator value. Everybody is requested to pay attention. See, the cost is calculated as interest minus interest tax saving. Because we understand that say we have a cost of the interest and due to that interest we get the interest tax saving advantage. So interest minus interest tax saving will be interest into tax rate. That is the way the interest tax saving will be calculated. So you can take interest common. Into 1 minus tax rate. Accordingly, the cost can be calculated, which is used over here as a numerator. Again, the logic is very simple. Numerator is indicating the cost that we incur, that is say for using the funds, which is equal to the denominator. We are incurring the cost of 6,000 for using 1 lakh rupee in the business. So for every 100 rupees it is how much? Because the cost of capital is calculated in annualized percentage term. So anything which is in percentage term, it means it is for every 100. I request you to write an answer. So over here, cost of funds to Mr. A in percentage term is amount cost for using 1 lakh cost is 6,000. Then for every 100 rupees it is how much? That comes to 6%. Or otherwise you can have a formula, and of course so this is what we are going to do in the subsequent questions. Interest into 1 minus t divided by amount, that comes to 10,000 into 1 minus 0.4 divided by 1 lakh into 100, that comes to 6%. The explanation of the cost is interest minus interest tax saving. Why minus interest tax saving? Because interest tax saving is an advantage that you have due to payment of the interest, and to that extent your cost will reduce. Interest minus interest into tax rate, interest is taken common. So in bracket I am writing 1 minus tax rate. So summary of the entire answer. In the first part of the question, we are required to compute the earning after taxes, that is 18 and 12. In second part of the question, it says that what is the amount by which the EAT is less of A, that is 6,000. In the third part of the question, important concept, very important, interest tax saving, the amount of the tax that you are able to save due to payment of interest. It is interest into tax rate, because 10,000 is the interest that you pay, and that is the amount by which your EBIT will reduce. So it is interest into tax rate, which you can cross verify 12 minus 8. Next is calculation of the cost of funds in percentage term to Mr. A. Again, it is an important question. For using 1 lakh rupee in the business, you incur a cost of 6,000. So for every 100 rupees, it is how much? Like that, so you calculate. That is the cost of debt financing. Regarding the cost, the formula is derived as interest minus interest tax saving, that is interest into tax rate. Interest is taken common, in bracket it is 1 minus tax rate. This is what we do. Now before we proceed further, friends, I just want to have an understanding of a point like this. There are certain points which I have written over here, which I want to explain you. So before going further, a company is raising funds from different sources of the finance, and it is invested in the business. So as a company, you may issue debentures, you may issue preference shares, you may issue equity shares, you may take a bank loan. Like that, so these are the different sources from which you raise the funds, and so you make investment in the business. Whatever the source from which the funds have been raised, they are supposed to be given a return. See, basically anybody is investing with you is of course say for the purpose of getting return. Nobody wants to make investment just for charity. So the debenture holders are supposed to be given interest. Preference shareholders are supposed to be given preference dividend. Equity shareholders are supposed to be given equity dividend, and so on. So whatever the return that you are supposed to give to them, that is the at least rate at which you have to earn from the business. In this chapter, we are going to learn what is the minimum rate at which the company is supposed to earn so that the return can be given to all fund providers. So we want to know a cutoff rate at which we have to earn. See, basically why only a single rate? Because whatever the investment that you make in the business, so that you cannot bifurcate. That this amount of the fixed asset is only out of the equity, and this working capital is only out of the debentures. That bifurcation is not possible, because the business is entire together, and from that only you have to fetch a single rate at which you have to earn. We are going to compute cost of the individual source of finance, and then weighted average or overall cost of capital to know a single rate at which the company should earn to give return to all fund providers. So in this chapter we are going to learn, so this is what we are going to have the learning, cost of the individual source of finance. Friends, from this question we initiate calculation of the cost of debt financing. Yes, this is what's the very first thing that we are going to start, calculation of the cost of debt financing. Now friends, over here you can very well understand that the cost of capital is going to be calculated broadly. It is not going to be calculated say with a narrow concept that what is the interest is my cost, what is the preference period is my cost. No, we are going to compute it broadly in a way that say whenever you issue debentures or whenever you take bank loan, whenever you issue debentures or whenever you take the bank loan, basically you are required to make the payment of interest. Whatever the interest that you pay is debited to P&L account. So you get advantage of the interest tax saving. So taking both of them, we will calculate cost of debt financing. When it comes to the calculation of the cost of debt financing for a security, we will take into account whether the security is issued at premium or whether the security is issued at discount. I give you certain explanation like this. See, as a company, I always have to pay interest at face value. I always have to pay interest at face value. However, if at all I issue the security at premium, then what will happen? I will be able to get more money and I have to incur less cost. So effectively the cost of raising the debt financing is going to fall. And if at all I issue the security at discount, then what will happen, dear students? I have to pay interest on the face value and I have received less. So the cost increases. So effect of issuing the security at premium or issuing the security at discount will be taken into account in calculation of the cost of debt financing. Redemption. In case of redeemable security, again these two things will be taken into account. See, the redemption may be at par value, may be at premium and may be at discount. You can very well understand if it is at premium, then cost to the company increases. If it is at discount, may not be permissible in India. If it is at discount, then in that case again it is going to be beneficial for the company. So these factors will be taken into account in calculation of the cost of capital. In case of the preference share, we understand that say we have to make the payment of the preference dividend. So that we will take into account. Issue of the security at premium, issue of the security at discount, redemption, suppose it is redeemable, then redemption is at premium, discount will be taken into account. Then there is one more term, dear students, called flotation cost. That will also be considered. Sir, what is flotation cost? I give you explanation like this. Let us say that there is a company called ABC Limited. It wants to issue the security. So basically what happens at the ABC Limited will have to approach to a merchant banker who will say do all due diligence, who will complete all the formalities say for ABC Limited for the issue of the security, and with that say the security is supposed to be issued in the market. The second important point, for the purpose of the issue of the security, ABC Limited is required to get its issue under return. So for that you are required to make the payment of the underwriting commission. Again, that payment of the underwriting commission is considered to be the part of the flotation cost. Then we understand that say we read number of times in the newspaper that say the companies are advertising that say we are coming with the new issue of the security. Whatever these expenses which the company is required to incur is considered to be the flotation cost. So whatever this flotation cost is, like the cost that you are required to incur to issue the security, is supposed to be considered in calculation of the cost of capital. So in short, cost of capital is supposed to be calculated broadly and not say only interest or only preference dividend. One last important point. We know again, once again in India, that say we are not allowed to issue the security for perpetuity. Yet, we are going to understand the concepts how to make the calculation of the cost of debt financing if the security is issued for perpetuity. How to calculate the cost of preference share if the security is issued for perpetuity. That is what say we are going to calculate. Because whatever the situation that we have in India is not the situation is everywhere in the world. That is the reason, say, if at all, say these securities are issued for perpetuity, how to compute the cost is what we are going to cover over here. So that on a general note, cost of capital. Friends, why cost of capital is calculated is what say I have already explained over here. Okay. In this note I have explained to you. You may write this. Now I am going to dictate a note to you with respect to the calculation of the cost of capital. Why do we do it? Covered. How we are going to do it is now covered. First point, cost of capital for any source of finance is calculated taking into account not only payment of financial charges, comma, apart from that, additional points will be considered. Second point, we will take into account that on A, issue at premium slash discount. B, redemption at premium or discount. C, interest tax saving. D, flotation cost. With paragraph write down and such other things. Third point, flotation cost means cost incurred to float the security. Full stop. It is incurred to raise funds from the market. Full stop. It is consisting of, read on A, payment of underwriting commission. B, payment to merchant banker to look after issue proceeding. C, advertisement expense to float the security. Full stop. With paragraph read down, and other such expenses. Full stop. Next point. In case of debenture and preferential, debenture and preferential, comma, an assumption is made that security is issued for infinity if directly or indirectly information not given about redemption. Full stop.